Hello and welcome. If you're starting to get serious about saving for retirement, you probably heard that you should be investing inside a retirement account, like an IRA. But then you run into a confusing choice: Roth IRA or Traditional IRA. They both sound great, but they work in fundamentally different ways, and choosing the right one can have a massive impact on how much money you actually get to keep in retirement. This isn't just a minor detail, it's one of the most important tax decisions you'll ever make. The good news is, the core difference is actually pretty simple once you break it down. In this video, we're going to clear up the confusion. We'll define how each account works with a simple analogy, explain the critical factors that should guide your choice, and walk you through how to open one. Let's begin. Part 1. The fundamental difference: taxes now versus taxes later. The entire difference between a Roth IRA and a traditional IRA boils down to one thing: when do you want to pay taxes? Let's use a simple analogy. Imagine you have a delicious, ripe apple, and the government is always going to take a bite representing taxes. The traditional IRA. Pay taxes later. With the traditional IRA, you get to contribute what's called pre-tax money. This means the amount you contribute is deducted from your taxable income for the year. But remember that apple, the government hasn't taken its bite yet. Your money grows tax-deferred inside the account for decades. However, when you retire and start taking withdrawals, every single dollar you take out is treated as taxable income. The government finally takes its bite out of the entire apple, both the fruit and the seeds. You pay taxes on your contributions and all your investment growth at your ordinary income tax rate in retirement. The Roth IRA. Pay taxes now. With a Roth IRA, you contribute money that you've already paid taxes on. There's no upfront tax deduction. Using our apple analogy, you immediately give the government its bite. What you put into the Roth IRA is yours after tax. The magical part is what happens next, that after tax, money grows completely tax-free. And when you retire and take qualified withdrawals, you pay zero taxes, not on the money you put in, and not on the decades of investment growth. The government doesn't get another bite. The entire, much larger, grown apple is yours to enjoy. So, the core question is, do you want a tax break today, traditional, or do you want tax-free growth and withdrawals tomorrow, Roth? Part 2. How to decide which one is right for you. This is the million-dollar question. The mathematically optimal choice primarily depends on one factor. Do you expect to be in a higher or lower tax bracket when you retire? The case for the Roth IRA. The Roth is typically the winner if you believe your tax rate will be higher in retirement than it is today. This is very common for young people just starting their careers. You're likely in a lower tax bracket now, so giving the government its small bite today is a good deal. As you progress in your career, you expect to earn more, potentially putting you in a higher tax bracket in retirement. Locking in today's low tax rate and getting tax-free withdrawals later is a huge win. Other key advantages of the Roth IRA. Tax-free growth. This is enormous. All the compounding we talked about in a previous video happens without the IRS taking a single penny of the gains. Flexibility. You can withdraw your contributions, but not the earnings at any time, for any reason, without taxes or penalties. This makes it a less locked-up account than a traditional IRA, though it's still best to leave it alone. No required minimum distributions or MDIS. With a traditional IRA, you are forced to start taking money out at age 73, whether you need it or not. The Roth IRA has no such rule, allowing your money to continue growing tax-free for your entire life, making it a powerful wealth transfer tool. The case for the traditional IRA. The traditional IRA is often better if you expect to be in a lower tax bracket in retirement than you are today. This is common for people in their peak earning years. If you are currently in the 30% tax bracket and expect to be in the 20% bracket in retirement, that upfront deduction at 30% is very valuable. You're avoiding a high tax rate now to pay a lower rate later. The reality check for most beginners. For many of you watching this, younger investors in the early or middle stages of your career, the Roth IRA is very often the recommended choice. The combination of likely being in a lower tax bracket now, the power of decades of tax-free growth, and the flexibility it offers is just compelling to ignore. Part 3. Rules, limits, and how to open an account. Both IRAs have rules you need to know, and the process for opening one is simple. Key rules and limits for 2024. Contribution limit. The total you can contribute to all your IRAs is $7,000 per year or $8,000 if you're 50 or older. Income limits. Roth IRA. Your ability to contribute phases out at higher incomes. For 2024, for single filers, it phases out between $146,000 and $161,000. For married couples filing jointly, it's between $230,000 and $240,000. Traditional IRA, you can always contribute, but your ability to deduct that contribution phases out if you or your spouse have a retirement plan at work and your income is above a certain level. How to open and fund your IRA. This is the easy part. You don't open an IRA at a regular bank. You open it with a major brokerage. Choose a brokerage. Go with a low-cost provider like Vanguard, Fidelity, or Charles Schwab. They are all excellent. Open the account. On their website, you'll find a clear option to open an account. You'll select either Roth IRA or Traditional IRA. The application is straightforward. Fund it and invest. This is the most critical step. Transferring money into the IRA is just the first part. Once the cash is in your IRA, you must then invest it in something like an S&P 500 ETF VU or a total stock market ETF VTI. Leaving it as uninvested cash is the biggest mistake beginners make. A final word of wisdom to quickly recap. What's the difference? Traditional IRA gives you a tax break now, but taxes withdrawals in retirement. Roth IRA uses after-tax money now, but gives you completely tax-free withdrawals later. How to choose? The main question is whether your tax rate will be higher or lower in retirement. For most young investors, the Roth IRA is the powerful favorite due to tax-free growth and flexibility. How to start? Open an account at a low-cost brokerage like Vanguard or Fidelity. Contribute, and most importantly, invest the money inside the account. Don't let the perfect be the enemy of the good. If you're unsure, opening a Roth IRA is a fantastic and likely optimal starting point for most. The most important thing is that you're saving for retirement in a tax-advantaged account. Taking this step puts you light years ahead of the average person. Thank you for listening.